I think YieldMax ETFs are a yield trap. If it sounds too good to be true, there's usually a catch. And in this case, it's you losing your principal value in exchange for that 40, 50, 100% dividend yield. So in this video, I'm going to be giving you alternatives to YieldMax ETFs. This includes the Roundhill ETFs as well, high quality dividend compounders with cheese that provide steady and reliable income in lieu of these yield traps. I know what I just said is very controversial and unpopular opinion because I know you, the folks that invest into Roundhill and YieldMax ETFs, you guys are fanatic about those distributions. However, please hear me out. But before we go anywhere, let me just give a quick and a brief introduction to YieldMax and Roundhill ETFs. By the way, yes, I'm wearing a Korea football jersey, but my hand gestures imply otherwise. I'm probably Italian, a little bit, maybe like 2% to 3%. By the way, did you hear the 23andMe company where you spit into a tube and they figure out what your DNA composition is? They're going bankrupt. Dude, I'm so glad I never ended up doing it. I mean, it was tempting, right? When everyone else was doing it, like in 2010, 2015. Oh my gosh, I'm actually white. Or wow, my grandfather's black. I never knew. Like if I were to spit into a tube, dude, it'd be a waste of money. They'd be like, dude, you're 100% Chinese, which is false because I'm actually Korean. That's why when it comes to trends and fads, I'm always a little cautious. If everyone else is doing it, then I take a pause and I reflect, what's the value add here? And with this 23andMe and spitting into a tube to figure out your DNA and all that else, it's like, dude, I don't know what they're gonna use that data for one day. They're gonna sell it to someone else. Eventually, when they go bankrupt, and lo and behold, they did go bankrupt. Speaking of fads and trends, isn't YieldMax one of them? Ba-dum-ts. But anyways, what they do is they utilize a very aggressive option strategy to generate an income. If you have no idea what I just said, I made a video, a dedicated video, explaining the methodology. So if you're curious and you want to learn more, go watch that one. As you can see on your screen right now, I'm on the YieldMax ETFs website. Front and center, their more popular ETFs include Tesla, which is the option strategy on Tesla. The dividend rate is 101%. I guess they call it a distribution rate. That's bonkers. And then you have, Apple, which is based on Apple. The dividend yield on that is 28%. And then you have the NVIDIA one right here, 65% distribution rate. Amazing, Amazon, 42%. GUI, which is Google, 40%. And the list goes on. And by the way, if my voice sounds a little deeper than usual, it's because I just woke up, washed my face, put water in my hair. It's like, dude, it's like 6:50 a.m. And I guess my voice is a little deeper in the mornings. And then gradually throughout the day, I turn into like a teenage girl. But it is what it is. So in the YieldMax ETFs universe, there's 46 different ones you can choose and pick from. And overall, collectively as a whole, there's $9 billion of total assets and 57% dividend yield on average if you pull it all together. However, when you think about their performance in the stock market, collectively, those 46 ETFs spits out a negative 41.9% total return in the past 365 days. I don't want to go through all of these, but we'll just look at a few to get an idea of what they do. So let's do NVIDIA, 111% dividend yield. Let's see how they're doing so far. They're currently trading for about $14.55. And in the past 1 year, the share price alone, they're down by negative 44%. Beginning of the last 365-day period, they were at $25.73. My goodness gracious. This is what we mean when we say NAV erosion, when we refer to YieldMax ETFs. However, I don't think people invest into these YieldMax ETFs for that share price appreciation. Rather, it's for that income, the distributions, okay? So let's take a look at their dividend profile. 111% dividend yield. So your annual dividend payout is $16.27, which is a lot higher than the share price itself. And the crazy thing about NVIDIA is that their dividend distribution period is every single month or every 30 days. Another really popular YieldMax ETF is Tesla. Let's take a look at their profile. They're currently trading for about $8 a share. When we take a look at the past 365 days, they're down by negative 44%, just like NVIDIA. About a year ago, ago, Tesla used to be $14.09. If we zoom out and take a look at what's happening, as you can see, they debuted on the stock market at $40.88 in November of 2022. And since then, their share price has just been eroding, declining, and selling off and getting smaller and smaller consistently. It's stable. However, once again, YieldMax ETF people, I hear you. You don't invest for the share price appreciation. It's for the dividends. Let's take a look at their profile. 124% dividend yield, which means for every share of Tesla that you own at $8, you get paid a $10 dividend payout. So that's why the dividend yield is higher than 100%. And once again, the distribution frequency is every 30 days. However, something that I do want to call out is when we take a look at their dividend payout visually as depicted by this graph, when they used to be about $40, $39 a share, their dividend payout used to be $1.99. However, their dividend payout has been shrinking in conjunction with the share price. As of right now, you can expect 46 cents every month. So as we scroll, as this share price gets smaller and smaller, my hypothesis and what I see through the data is that their dividend payout is also going to get smaller and smaller. So even though the dividend yield might be sustainable at 120%, or even like 150%, the payout itself is shrinking. And that's why when you take a look at their dividend growth rate, it's negative 34%, which is pretty much in line with their share price eroding as well. So that was YieldMax ETFs, and on a surface level, it's pretty attractive. I can see why a lot of newer or dividend income focused people would be drawn to that type of investment strategy. A 56% dividend yield across 46 ETFs, and some of them even spit out a dividend yield above 100%. I can see why it's attractive, but as for me, it's not my cup of tea. This right here is a liter of green tea. Ever since I moved to Japan, dude, I've been drinking a lot of green tea because you have some of the best green tea available in the world. Super cheap, very affordable. So I drink it every day, and one thing that I notice is that my teeth is getting yellower and yellower by the day. Is it worth it? I think so. I think it's a really good alternative to coffee. But anyways, their counterpart, the Robin to the Batman, is Roundhill ETFs. And currently there's about 27 different Roundhill ETFs available. Total assets, if you pull it all together, is $3.9 billion, which is not that much when you spread it across 27 different ETFs. And their 1 year total return is negative 1.8%. However, unlike the YieldMax ETFs, I would argue the Roundhill ETFs, their dividend yield pulled together collectively, 10.7%, it doesn't sound as ridiculous and egregious. And that's because not all of their ETFs and investment strategies pay out a dividend yield, as you can see on your screen. I think their most popular one is this one, MAGS, which is the MAGS 7. The dividend yield is 1%. However, I want to focus on these ones right here. They pay out a dividend every single week. And as you can see, their overview, their dividend yield is 51% for Q dot, and then 33% for X dot. Let's just go through each one right here. Roundhill Innovation Covered Call Strategy ETF, currently trading for about $30. If we zoom out 1 year, do they at least have a year of history? Yes, they do. They used to be $43. What's their total history? It looks like they debuted about a year ago, March of 2024. And it used to be about $43, $44. Now they're currently $30. Share price erosion is negative 31%. Again, I know you guys don't invest into it for the share price. Let's look at their distribution and dividend profile. 51% dividend yield. The payout schedule is every single week. Every share of Q dot that you have at $30, you get paid $15 a year in dividends. Now let's look at their cousin X date. This is the S&P 500 covered call strategy. Currently $39 a share. I guess just shy of $40. Let me just zoom out to see what their entire history looks like. It looks like they debuted March of 2024. Not a lot of history, but about a year ago, they used to be $50.48. Since then, they have eroded by negative 21%. Their dividend profile, 33% dividend yield. Dividend payout schedule is every single week. Annual dividend payout is $13.50. I think I already touched upon it, but I wanted to elaborate my thoughts. Yes, when we think about their high dividend yield, 50%, or in this case, like 120%, it's really juicy on a surface level, right? And it looks great and it looks sustainable. However, what we have to keep in mind is that it comes at a cost. Number one is going to be the eroding capital appreciation. Right now, I'm utilizing Google Finance. When we zoom out for their entire history, it looks like Nifty debuted May of 2023 at about $19.83 a share. And since then, the share price has just been eroding, negative 26%. So what I'm gathering from this is if my portfolio valuation, if I had thrown down like $10,000 into Nifty about 2 years ago, my portfolio valuation would be about $8,400 if I did not take those distributions and the dividends and reinvested it back into the portfolio, if I just used it to do whatever I wanted. And it's not just Nifty. If we also look at Tesla, which is another really popular one, I think this one has the most history out of all of the YieldMax ETFs, and that's point number 2. If I zoom out, say maximum timeline, Tesla debuted in November of 2022, and this one has the most timeline. So when I think about it like that, the YieldMax ETFs and Roundhill, we're not working with a lot of history. We don't know if their strategy is able to be pulled off 10 years from now, 20 years from now. We don't know how they're going to function during different market cycles, a bull market, a bear market, a recession that seems to be pending right now in the US. We don't know. And the crazy part is, if I circle back to point number 1, the eroding capital appreciation, $40, right? Maybe I got super excited and I was like, you know what? I'm going to put $10,000 into Tesla. Look at this, 2.5 years later, that 10 grand would have transformed into $2,000. Your portfolio valuation would be shrinking, eroding, declining. And that's why I think point number 3, YieldMax ETFs and Roundhill, I think they give you an illusion of profit, because what you lose in the share price, you get back in dividends. So it's almost like you're gaining no money in the end. And that's why I think it's really important to evaluate and judge YieldMax ETFs by their adjusted stock price performance instead of just the share price, or instead of just looking at the dividend profile individually. And that's what we're going to do right now. So taking into account Tesla's very high dividend yield of 100+% and their share price of how it's fluctuating up or down, their total return for the past 2.5-3 years is negative 8.5%. And that's why I'm articulating point number 3 of illusion of profit. It looks like you're making money because of the high dividend payout, but because of the NAV erosion, you're actually losing money in terms of a total return. And it's not just with Tesla. We can go down the list of the 46 different ETFs, and this one right here, Amazly, which is the Amazon equivalent, past 1 year, your total return is negative 6%, taking into account the very high dividends. So what I'm saying is those very high dividend payouts, it's still not enough to save the performance of this investment choice. And that's why I'm saying, what's the point of investing into YieldMax or Roundhill ETFs if you know that the data and the numbers show us objectively that over time, in the long run, you're losing money? Not by a lot, not like negative 50% or negative 80% like we saw from the share price chart, but when you factor in the dividends, you're still losing money in the end. In a span of 365 days, 700 days, it's like negative 6%, and I think Tesla was like negative 8%. So I'm like, what's the point? You're just giving YieldMax or Roundhill money to slowly lose money, if that makes sense. So what do I like to invest into instead? I'm just going to pull up my YouTube channel's biography. I like to invest into dividend compounders with cheese. High quality businesses that are crushing it across the board. When we think about their fundamentals, their financials, their metrics, their free cash flow per share, their dividend payout ratio, their dividend growth rate. Businesses that are profitable, possess a strong balance sheet. Do they have more cash and cash equivalents on hand than they do with total debt? And I guess the X factor here, the cheese, the Parmesan, the mozzarella, is the fact that a dividend compounder, their share price does not get deflated with time. Meaning 6 months or 18 months or 36 months from now, a dividend compounder, they compound your wealth because not only from their dividend growth rate, but also from their share price growing as well. With YieldMax and Roundhill, you can almost guarantee from the data that we have available right now that share price is going to be eroding, so it counterbalances the high dividend payout. And I want to make this point. High capital expenditure and debt is okay if they have the EBITDA to back it up. And I'm saying this because there's one popular finance YouTuber who screams and shouts that CapEx is disgusting and should be avoided at all costs. And that's why he only likes tech and software service type of companies. And I could not disagree more because there's good value and good businesses across all industries and sectors. Because how I see it is CapEx is a sign of long-term vision. They're laying down the foundation and the groundwork today so that in 10, 20, 30 years, they can reap their reward, the fruits of their labor. Case in point, Walmart and their supply chain distribution build out in the 80s and 90s. Investors in Wall Street were adamant and jumping up and down saying, this is a terrible decision. Why are you spending so much money building out your supply chain infrastructure for the truckers, for your distribution centers? Why are you doing that? Fast forward 30 years later, Walmart is best in class and they have one of the highest market caps in the stock market because of their economies of scale, and they're able to do their business at a more efficient and optimized business value because now there's a Walmart close to about 90% of Americans in a proximity of 15 minutes or less. And their distribution centers are all within 1 day's drive. So what I'm saying is CapEx and the high upfront investments, it creates an economic moat and a competitive advantage for them 5-15 years from now. And that's why I like food CPG companies, defense stocks like Huntington Ingalls, Lockheed Martin. That's why I like restaurant stocks, because eventually that CapEx turns into reliable and steady cash flow. Emphasize that point even more. When Google and Microsoft announced that they're going to have to increase their CapEx spending to build out their cloud network, Wall Street hated it. But for me, as a long-term investor, I can see how that's a good thing for their business and operations. Because if they don't have the infrastructure and the capacity and the bandwidth available to sustain all of their different endeavors in the cloud, Azure, and for Google, it would be like YouTube, then their business can be capped at how much they can potentially grow. So CapEx is not a bad thing as long as the CapEx transforms into steady and growing cash flow, if that makes sense. And that's why I disagree with that YouTuber. I think CapEx is not a bad thing as long as the company has a good game plan as to why they're doing it and if it makes business sense. Building out another factory so that you can churn out more products so that you can sell it and meet the supply and demand is a good thing. CapEx is not a bad thing. I guess 80% of the time. 20% of the time, it's stupid. So why am I embracing this dividend compounders with cheese philosophy? It's not just because of the YouTube channel name, but the whole idea behind dividend investing for me is to invest into good businesses. It's about being patient. Slow and steady growth that is sustainable over the long run. For me, I think it's counterintuitive to chase something that pays out a 70, 80, or 100% dividend yield. If that's the move and the priority, then I might as well not do dividend investing altogether. It's the same reason why I don't go after speculative growth companies that are unprofitable with shaky financials and they're just drowning in debt. Because for me, as a guy that really looks up to Warren Buffett, I think the fundamentals and financials really do matter. I will not invest into you just because everyone else is hyping you up if I know that your top line, your free cash flow, and everything else is just declining. It tells me that your business is just all smoke and mirrors. So all that to say, the promise of a 70% dividend yield or 70% growth in a very short time frame is just outside of my comfort zone and my risk tolerance. It's just not up my alley. So for me, it's about quality over hype, or whatever it is that's trending in the dividend investing community. Even if that means that I know about Misty and Connie and all these other Roundhill and YieldMax ETFs, and foregoing a 100% dividend yield because I would rather just receive a 6 or 8 or even a 10% dividend yield that I know is coming from a quality source and that my portfolio valuation is not going to be eroding 3 months, 6 months, 9 months from now. And last but not least, I prefer to invest into dividend compounders that are tried and true, that are battle tested, that have a lengthy history to show us how do they perform in the stock market and what is their dividend history looking like. Did they cut it when times were hard? How did they endure through the recession, through the pandemic and whatnot? If their history and numbers show a compelling story that it's a quality investment, then I'm in. Dividend compounders are pound for pound the best type of investments that I can make in the stock market. That's why I choose to invest into them. So with that said, without further ado, what are the alternatives that I choose to invest into instead of YieldMax and Roundhill ETFs? To kick things off is going to be Blue Owl Capital. Ticker symbol OBDC. Their dividend profile right now, their dividend yield is 12.3%. And in the past 5 years, their dividend payout on average has been growing at a rate of 9.7% year over year. But how does that play out in terms of their adjusted stock price performance? Let's see. Past 5 years, 100%. When you take into account the dividends paid out plus the share price appreciation. So unlike the YieldMax and the Roundhill ETFs, with OBDC, your portfolio valuation would have 2x'd. So if you had $100,000 invested into OBDC, you reinvested the dividends, that $100,000 in 5 years would have turned into $200,000. And I think this is a really good time for me to call this out. And I'm not singling this person out, but they commented on my BDC video that I made talking about the best BDC stocks for beginners. They wrote, "I am appalled at how naive people can be. Getting a 10, 12, 13% dividend yield on a long-term basis on a single stock means that you're crushing the market. You're basically Warren Buffett. You're the best investor of all time. This screams massive trap." And I don't blame them. Right? I think a lot of us, when we get influenced, we just regurgitate what other people say, what we hear and see on the internet. When people say like, oh my gosh, BDCs and REITs, they suck. We see that and feel a certain way, and then that becomes a part of our philosophy without doing our homework to figure out whether or not that's true. So with OBDC, let's go ahead and compare it to SPY, which is the S&P 500, which is commonly referred to as the market, the benchmark, the standard that all investors are trying to beat. So when we zoom out and look at the past 5 years, with the market, you're getting 102% total return. For OBDC, it's 100%. So at the end of the day, it's almost apples to apples. Are you beating the market? No, you're just shy of it. However, in lieu of the share price appreciation that you get through the S&P 500, you get a sustainable and a high dividend yield of 12, 13% through OBDC. That also allows you to have a performance that's very similar to the S&P 500. Which takes me to the second stock that I would invest into for that steady and reliable dividend income instead of YieldMax ETFs, and that's going to be Main Street Capital. This is another BDC stock, and I'm going to compare it to the S&P 500 so you can see that even though it pays a very high dividend yield, it is not a quote-unquote trap like this person is implying. So Main Street Capital, ticker symbol MAIN, if we scroll down, their dividend yield is 7.8%. Past 5 years, the growth rate is 3.7%. And as we jump back over here to see the performance against the S&P 500, past 5 years, Main Street Capital, 212%, the S&P 500, 102% in 5 years. So the data and the numbers, they do not lie. It is objective. Yes, BDCs and REITs, not all of them can beat the market or meet their levels, but the best and the high quality ones, dude, it's not a trap. And that's why whenever you see someone say on the internet that BDCs and REITs suck or that CapEx is terrible, don't just take it as surface value and then just throw it into your brain and then regurgitate it next time you think about it. Rather, do your own homework, because if you do, you'll find out that that's completely wrong. You might be like, dude, that's only 5 years. I bet the S&P 500 wins over the long run. And for you, please sit back down, pick up that glass of water, start sipping on it. Dude, you're dehydrated, you're fuming, the veins are popping in your forehead. Check this out. If we look at the past 10 years, Main Street Capital, their adjusted stock price total return, 265% to S&P 500's 196%. Meaning your money would have grown by 265% from investing into a BDC that has a ridiculously high dividend yield. Whereas, as we learned recently with the YieldMax and the Roundhill ETFs, your money would have shrank by negative 8% or negative 6%. BDCs, on the other hand, make you money. Let's zoom out even further. Let's do 15 years. 970% for Main Street Capital, S&P 500, 479%. So you're telling me, in 15 years, by investing into a BDC that pays a ridiculously high dividend yield that is sustainable from a high-quality business operation, my money would have 9x'd. That's exactly what we're saying here. If we do 20 years, I wonder what happens. In 20 years, S&P 500, 568%. That's pretty good. That's juicy. I would be happy with that. But on the other hand, this BDC with a trap dividend gave you 1,449% total return. And the kicker is they can't even go back 20 years because their inception was November of 2007. So the S&P 500 gets almost 2 years of more timeline and they still can't beat a BDC. So that is stock number 2 that I would buy into rather than these traps. The real traps or YieldMax and Roundhill ETFs, not necessarily high quality BDCs and best of the best REITs. Yes, there are some trashy, crappy, ugly, disgusting, smelly BDCs and REITs, but we're not looking at them because they don't quantify and fit the definition of a dividend compounder with cheese. The next stock that I would buy is Ares Capital, also known as ARK, currently trading for about $20. Let's look at their dividend profile, a 9.5% dividend yield, and for the past 5 years, our dividend growth rate is 3.7%. Once again, let's just do this exercise. ARK versus the S&P 500. Let's zoom out 5 years and see what happened. For ARK, you got 171% return on your investment. S&P 500, 102%. If we zoom out 10 years, we're talking about 204% to 196. If we do 20 years, then we're talking about 920% to that of 568%. So when I think about the BDCs, Blue Owl Capital, Main Street Capital, and Ares Capital, dude, those are easy yeses for me because the data and the history shows us that their high dividend yields are sustainable and they give you market-beating returns, unlike YieldMax and Roundhill. Okay, to be quite frank with you, Blue Owl met the performance of the market. They didn't beat them. I understand, okay? However, Ares and Main Street, on the other hand, they did beat the market. And the next one is going to be a REIT. By the way, the longer this video goes on, the more I'm waking up. Now it's like 7:50 a.m. It's going to be Realty Income Corporation, ticker symbol O. And their dividend profile. Right now, their dividend yield is 5.6%. Their dividend is growing at a rate of 3.6% year over year for the past 5 years. And once again, I'm going to compare it to the market because I don't want wise people to be like, dude, this is a trap. It can't even beat the market. I want you guys to just please sit down and watch the video and look at the history and the data and the numbers speak for themselves. All right? Before labeling me as a fraud and a liar and a cheat and a scandal and that I'm stupid. Before you say mean things like that hurt my feelings, please allow the numbers to do the talking. Now, I want to preface this by saying that REITs for the past 5 years have been struggling because of a high interest rate environment. So, past 5 years, I can almost guarantee that Realty Income probably underperformed the market. But remember, their dividend yield is 5.6%. And come to find out, it's true, right? S&P 500 was 102%. Realty Income is 52%. You might dismiss this and be like, dude, this is crap. This is ugly. Why are you bothering to show me this stupid company, Realty Income? Because historically, the data has shown us that REITs have outperformed the S&P 500, at least for the past 80 years, except for the recent 5 years. That's what the data shows us. However, when I think about a dividend compounder, I think their greatest ally and friend and asset is time in the market. Because a high quality investment, if they have time to compound, that's when the true beauty and magic happens. So With that said, if we zoom out 20 years, this will include the financial recession and this recent high interest rate environment that is unfriendly for REITs. 20 years, we're talking about S&P 500 was 568%, Realty Income Corporation 626%. So they come out on top of the market. And I don't really have anyone else to share this with, so I wanted to tell you. Recently, there's a trend that's happening all over social media, mainly TikTok with the youngsters, right? People that are like 20 years old, 19 years old. It's where they go to the recent Minecraft movie physically in the theaters, and in a particular scene, all the youngsters will jump out of their seats and throw popcorn and their sodas all over the place. And the reference, they start screaming chicken jockey while they do it. I hate to see that because at the end of the day, someone is going to come in there and have to clean after these idiots' messes. And it's just not fair. And that's just rude. And where's the manners in that, right? I sound old, right? It's like telling someone to get off my non-existent lawn because I can't afford to buy a house right now. But eventually that is one of my dreams in life. I do want to acquire and own my own home, but as a 35-year-old who makes minimum wage, I don't see that happening anytime soon. But anyways, I hate that, right? I think social media can be used in a beautiful way to help people, to educate, to learn, and to do good things. But ultimately, when we use social media for clout and to show off and to practice and share these stupid trends, like throwing popcorn all over the place, dude, it just rubs me the wrong way. It makes my nipples extra dry. I remember during the pandemic, like 3 or 4 years ago, there was also another TikTok trend where all the youngsters were emulating and copying. It's where you go into a grocery store and you open the lid of an ice cream bucket. I think it was like Blue Bell, Ben & Jerry's, one of those, and you lick it, you put the lid back on, and you put it back onto the shelf. And people were copying and doing it all over the country. And I don't know about you guys, but I do not find that funny at all. It actually pisses me off. So I hope these trends of people destroying property or endangering the lives of others intentionally, I hope it stops because it's ridiculous. Anyways, moving on to the next company that I would invest into rather than YieldMax and Roundhill is going to be another REIT, and that's known as Rexford Industrial. Ticker symbol REXR, $32.70. Dividend profile, 5.2% dividend yield. Past 5 years, their dividend is growing at a rate of 16.9% year over year. Pretty juicy. And once again, we're going to compare them to the S&P 500 to see who really comes out on top. And let's take a look at this. Past 1 year, Rexer is negative 23%. Yes, REITs getting demolished, crushed, but I think it's temporary. I think eventually, once the inflation rate comes back down to earth, they're going to rebound and recover, and they're going to be fine. In the short term, pain. Okay. However, if we do 10 years, then we're talking about 196% S&P 500 to Rexer's at 168%. It's not too bad. Yes, the S&P 500 did outperform them. However, I think once Rexford gets their rebound rally and they recover from their depressed prices right now, I think they'll beat the market. You can quote me on that. That's not financial advice. I'm just saying it. I think that's my prediction. And that's why I am invested into them. And if we do 15 or 20 years, we can't because Rexford does not have the timeline to go back that far. They debuted back in 2013. And so if we compare them for the past 15 years, the S&P 500 has like 2.5 to 3 years of more timeline to work with. So it's not a fair assessment. However, I still think it's head over shoulders better than any YieldMax or Roundhill investment choices out there. So I would pick Rexford any day of the week over them. And the next one is going to be Altria, ticker symbol MO, the first qualified dividend paying company on this list. And they're currently trading for about $57 a share. And as we take a look at their dividend profile, their dividend yield is 7%. Past 5 years, growing at a rate of 4%. Pretty good. Not the best numbers, but pretty good. And something that I do want to call out is they've been growing their dividend for the past 55 years. 20 years older than me, they've been growing their dividend. That's bonkers. And as we take a look at their performance in the stock market, let's just see what happens. This is going to shock you. Are you ready? When we zoom out to the past 5 years, the S&P 500 was 102%. Altria was 111%. Nothing to write home about. Yes, Altria did win by a little bit, but nothing too crazy. But check this out. If we do 15 years, then Altria was 585%. Your money would have 5x'd. in 15 years. S&P 500, 479%. Once again, a very high dividend yield that is qualified, meaning it's taxed at a favorable rate at the capital gains rate, and it beats the market. How beautiful is this? Now, this is where it gets crazy. Diabolical, and you might be like, dude, you're making stuff up. No, I'm not. Let me show you. If we look at the past 20 years, Altria versus the market, who do you think is going to win? 20 years? 1,700% with Altria. With the S&P 500, 568%. So, when I think about Altria, it is quite literally the prototypical, the example. If you open up a dictionary and look up dividend compounded with cheese, Altria is going to be one of the examples. 1,756% return in 20 years. That is crazy. They always find a way to continue compounding throughout the ages and in the stock market because of their high dividend yield, but also because they preserve and grow their share price. It takes two elements to compound: the dividend growth rate and the share price appreciation. If you don't have one or you don't have either, then you're not going to compound. That's why with YieldMax, their eroding share price is what is holding them back. Now, I'll eat my shorts, take off this jersey, and I'll cut it up, put it in the microwave, and eat it as well, if they find a way to sustain their share price while maintaining a 50, 60, 80% dividend yield. If they can do that, sign me up. I'm right there with you. I'll be at the front lines with a shield and an axe saying, wow, YieldMax all the way. I'll be right there. But they can't do that. As we see by the data, and their short history, their share price is just getting crushed. And the next one is going to be a food CPG company known as Flowers Foods. I just bought into them, 10 shares. Oof, I'm rich already, 10 shares. Anyways, currently trading just under $18 a share. The dividend profile is 5%. Qualified dividend payment. Qualified. Growth rate is 4.7% past 5 years. And if we look at their adjusted stock price total return for the past 20 years, we're talking about 469%. If we compare it to the S&P 500, I think the market wins by a huge margin. Past 20 years, the market was 568%. Flowers Foods was 469. But once again, even though it underperformed the market, I still think it's head over shoulders better than any YieldMax and Roundhill ETF. Because, check this out, when we take a look at their share price appreciation throughout the ages, I think Yahoo Finance only goes back to like 1985. Their history is a lot longer than that, to 1968. But when we take a look at their share price performance, all time, 1985 till now, 22,600%. That is absolutely diabolical. That's why I think Flowers Foods also deserves to be on this list. And the next one is another food CPG company, Conagra Brands, ticker symbol CAG. Dividend profile, 5.4% dividend yield. Past 5 years, the dividend is growing at a rate of 10.4% year over year. And when I say that, I'm referring to this right here. The payout of $1.40 is growing 10.4% year over year. Hopefully that makes sense. And Conagra did underperform the market in terms of their adjusted stock price total return. However, I still think they deserve to be in the conversation with dividend compounders with cheese, because when we take a look at their share price total return since 1985, it's 5,000%. Yes, food CPG companies for the past 5 years, they're kind of in a pickle. However, ultimately, if you zoom out in a bird's eye view, they are dividend compounders. And qualified dividend payment above 5%? Dude, sign me up. That's easy. Is it going to beat the market necessarily? Not right now. No, but maybe in 10 to 20 to 30 years, it could, possibly. And last but not least, we have to talk about SCHD. I'm a new member of the cult. Who am I if I don't give them a shout out and a mention? So, they're currently, $25 a share, dividend profile, 4% dividend yield. Past 5 years, growing at a rate of 11.4%, which is close to their historical average of 11.5% dividend growth rate. When we take a look at their adjusted stock price total return, past 1 year, 3.1%. Pretty atrocious. However, if we compare it to the S&P 500, I'm using SPY. You could use any S&P 500 index such as like VU, doesn't matter, but I'm just using SPY. And if we look at the past 5 years, the S&P 500 beats SCHD. If we do 10 years, they beat them as well. 175% to that of 196%. And if you're thinking like, can we do 20 years? We cannot, because SCHD's history starts at 2011. So the S&P 500 would win because they have a lot more timeline to work with. However, if we scroll down and take a look at their 15-year CAGR, how much your money would have grown when taking into account the dividends paid out plus the share price appreciation, for SCHD it's 12.3%, and for SPY or the S&P 500 that's 12.5%. So, yes, the market does beat SCHD, but not by a huge margin that people like to spew and spread false information. It just slightly underperforms. However, I think SCHD is a really excellent alternative to get a qualified dividend payment that is growing at a rate of 11.5% historically. Now that you witnessed my list of stocks that I would buy as an alternative to YieldMax and Roundhill, now I want to shift our attention to something else. So let's go ahead and say, if I were trying to create a portfolio that spits out income that is reliable, steady, this is what I would do in lieu of Roundhill and YieldMax. So what you see on your screen right now, if I were to right now, April 2025, to create a dividend income portfolio and I needed $1,000 a month in dividends, this is what I would do. It would cost me $200,000, and this is how I would allocate the portfolio across 4 investments. Not 20, not 100, just 4. I would allocate 37% of the portfolio to SCHD, about 32% to Flowers Foods, 14% to Altria, and 16% to Blue Owl Capital. And I think this is a good mix of balancing a high dividend yield with a high dividend growth rate. Because when you think about it, Blue Owl has the highest dividend yield of 12.9%, but their dividend growth rate is the smallest. And on the other hand, the one that I have the highest allocation towards, which is SCHD, their dividend yield is the smallest out of the 4. However, their dividend growth rate is the highest. So it balances itself out, and the annual dividend payout that I can expect from this cost $200,000 would be $12,900 in dividends. Is it crazy? Is it bonkers like YieldMax or Roundhill? No, but it's sustainable, and your share price and the portfolio valuation of $200,000 is not going to turn into $80,000 a year from now. Now, pretending this was a McDonald's and you wanted to supersize it because $1,000 a month in dividends is not enough, then this is what I would do. The portfolio would now cost $400,000, but it spits out $2,150 a month in dividends. And that's just for the first year because the dividend growth rate is 5%, meaning the annual payout of $25,000 is going to grow by 5% the next year. That's if I don't reinvest the dividends. This dividend payout, this portfolio, that sustainable income, it's going to grow by 5% year over year. It's pretty good. It beats the historical rate of inflation. And that's why I allocated so much to SCHD in this hypothetical portfolio. Well, let's go ahead and say, dude, extra large, still not big enough. I need an XXXXL because I have oversized nipples, okay? So to supersize the portfolio one more time, with an $800,000 portfolio, if I wanted that steady dividend income, well, this is what it would look like, right? The annual dividend payout is $51,600. Dude, that could absolutely replace all of your living expenses, this passive income. The monthly dividend payout, $4,300. I mean, for year one, 51 grand growing at a rate of 5% year over year, that's pretty good. I think this is good money. I think this is what my portfolio would look like if I were to retire today with $800,000. This is what I would do. This is not financial advice. This is just what I would do. So that just about wraps up the video, but I do want to say this. At the end of the day, when you take off your XXL underwear and you go shower naked and you think about it, this game that we're all playing, it's not about chasing the highest yield that you can find on the internet. Like, oh my gosh, this YieldMax pays out 120% dividend yield. So it's not that. That's how you end up in trouble. Rather, investing is about building a sustainable income that grows with you over time. Because as we learned with YieldMax and Roundhill, it's not sustainable. Because eventually that dividend payout does shrink in line with the share price getting demolished. So even if it pays an 80% dividend yield, what's the point? It's not sustainable. So it's not a long-term investment. And that's why this is not financial advice, but I would rather stick with high-quality companies, businesses that are making real money, pay consistent dividends, and they don't crumble over time in terms of their share price. I would rather invest into that. So, this is not financial advice, but if you were hypothetically one of my best friends, I would say this to you. Please do not fall for yield traps. If you want your money to work for you, it needs to last. Not just today, not just next month, but 10, 20, 30 years from now. You want that portfolio valuation, that NAV, to be preserved, but also to be growing. You don't want to see it be eroding and falling and crumbling. Please don't do it. Please! So before I sign out, what am I missing? What other dividend compounders would you add to this list that pay a juicy dividend yield and is a really good alternative to YieldMax and Roundhill for the people that have fallen into that trap and cold? What would you recommend? Because honestly, if you are investing into YieldMax and Roundhill, it's not too late. You can always change your strategy. You can always adjust your portfolio, and it's never too late to invest into dividend compounders instead of yield traps. It's never too late. All that to say, I love you guys. I mean it when I say that. If no one has told you recently that they love you, well, I do. I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you next time. You are appreciated, and your life is worth living. Peace.